Florida, known for its sunny beaches, theme parks and retirement communities, has long been a popular destination for home buyers and investors. However, the state's housing market has recently experienced a dramatic and unusual collapse, as over 200,000 homes were listed for sale in a single day, causing prices to drop and buyers to panic. What caused this sudden and massive influx of supply, and what are the implications for the state's economy and society? Let's find out, analyzing the Florida real estate meltdown. The Florida housing market is in trouble, and it's not looking good for property owners and potential buyers. During the 2020-2021 period, low interest rates led to a surge in people leaving high-cost cities like San Francisco and New York. They were selling their buildings and flocking to places like Miami, where rents were skyrocketing at alarming rates of 15 to 30% per year. It was a real estate frenzy, but as the tide turned, property owners struggled with increased insurance, taxes, vacancies, and evictions. Many property owners who initially bought into the boom for a 4.4% return faced the challenge of offsetting mortgage rates ranging from 3% to as much as 7.5% or even 8%. This shift and rising insurance rates are unconducive for many people, and we might witness a wave of properties returning to the banks. The Airbnb market is not immune to the turmoil either. Those who bought into the Airbnb craze, expecting it to be the promised land, might have more inventory than expected. As property owners tried desperately to hold on to their investments, Airbnb sellers could flood the market. Additionally, potential buyers are facing unexpected challenges in securing mortgages for Florida condos. It has been discovered that Fannie Mae maintains a secret quasi-government block list that determines mortgage qualifications. Condos, especially in Florida, are on this confidential list due to maintenance and financial issues, making it difficult for buyers to secure loans. The situation is evolving into a perfect storm for the Florida housing market. Lenders are becoming more conservative, and sellers are getting priced out as insurance and taxes continue to rise. As a result, we might be on the brink of witnessing one of America's biggest real estate bubbles, reminiscent of the 2008 crisis. The shocking collapse of Florida's housing market has been hit hard, with over 200,000 homes flooding the market in just 24 hours. The situation is alarming, and it's crucial to understand the factors contributing to this collapse. The root cause seems to be the soaring cost of property insurance in Florida. The state is facing a property insurance crisis, driving up the cost of home insurance. Floridians already pay 3 times the national average in premiums, and with insurance costs on the rise, it's becoming unsustainable for homeowners. The impact is evident in the surge of homes listed for sale, reaching over 200,000 properties. This has led to a significant increase in home inventory. The situation is predicted to worsen, potentially surpassing the highs of 2020 and returning to 2018 levels. The insurance crisis is hitting residents hard, with homeowners paying an average of $6,000 annually for insurance alone. This financial burden is driving some to consider leaving the state. Areas like Jacksonville and Miami are experiencing a drastic decline in home sales and median prices. Jacksonville has seen a 65% drop in median sales prices compared to a year ago, while Miami's median sale price slid by 2.5%, coupled with a nearly 9% decline in sales. Condo sales in Florida are also plunging, worsened by the high cost of home insurance. Owners are eager to offload properties, leading to an increase in listings, but the homes are proving difficult to sell. The impact is not only financial, but also emotional for homeowners. Some are forced to sell due to insurance assessments. Others are struggling with insurers dropping coverage or doubling premiums, making homeownership an increasingly challenging prospect. The situation is changing the relationship between renting and buying properties. With the median rental price for a one-bedroom at $1,325 compared to the average home cost of $3,900, potential buyers face a difficult choice. However, the escalating insurance costs may drive more people towards renting, leading to a potential fall in rental prices. Also, the crisis extends beyond homeowners to investors, particularly those who entered the market during the real estate boom of 2020 to 2021. The combination of increased insurance rates, higher taxes, and reduced property values may force many property owners to reconsider their investments, leading to a potential increase in distressed sales and a rise in rental properties. Other factors responsible for the crash. To understand the magnitude of this housing market collapse, one must examine the various economic forces that created this perfect storm. Firstly, rising interest rates and tightening lending standards made it increasingly difficult for buyers to secure mortgages, dampening demand and leaving sellers with few options but to lower their asking prices or withdraw their listings altogether. Simultaneously, fears of a looming recession and concerns over job security led many homeowners to prioritize financial stability, prompting them to put their properties up for sale in hopes of cashing out before the market took a further downturn. The investor exodus. Florida's housing market had long been a magnet for real estate investors, drawn by the state's sun-soaked beaches, thriving tourism industry, and favorable tax policies. However, the recent housing market upheaval has prompted many investors to cash out their holdings, fearing a prolonged downturn that could erode their profits. This mass exodus of investors and the influx of owner-occupied homes hitting the market has created an unprecedented supply surplus that has sent property values plummeting. The pandemic's lingering effects. The COVID-19 pandemic played a significant role in shaping the current housing landscape. With remote work becoming the norm, many families sought out larger homes in more affordable areas, leading to a migration trend that saw Florida's housing prices skyrocket. However, as companies began calling employees back to the office, the appeal of living in the Sunshine State diminished, leading to an excess of inventory as homeowners sought to relocate. Also, the pandemic's economic fallout left many households financially strained, forcing them to consider selling their homes to alleviate financial burdens or avoid foreclosure. Florida was one of the hardest hit states by the COVID-19 pandemic, which triggered a series of lockdowns and restrictions that severely affected the state's tourism, hospitality, and entertainment industries, which are the main drivers of its economy. Many businesses closed or downsized, and many workers lost their jobs or income. This reduced the demand and affordability for housing in the state and has increased the financial stress and uncertainty for many homeowners. Some have decided to sell their homes and move to other states or countries, while others have been unable to keep up with their mortgage payments and have faced eviction or foreclosure. The possible outcomes and consequences of the crash. The Florida housing market crash has been described as the worst in the state's history and one of the worst in the nation's history. The crash has had devastating and far-reaching effects on the state's economy and society, and has also had implications for the national and global markets. The housing crisis has caused a severe contraction and slowdown of the state's economy, which relies heavily on the real estate sector. The crash has reduced the wealth, income, and spending of millions of households and businesses. It has also reduced the state and local government's tax revenues and public spending. The crash even disrupted the credit and financial markets and increased the risk and uncertainty for investors and lenders. The housing market collapse has had a ripple effect on various industries, including tourism, hospitality, and entertainment. These sectors have experienced a decline in visitors and customers. Additionally, the construction, manufacturing, and service industries have been impacted by a decrease in orders and contracts. The labor market has also suffered from job losses and reduced wages. Similarly, trade and commerce have been affected by a decrease in markets and opportunities. Also, the housing market crash has caused severe deterioration and disruption of the state, which relies heavily on the stability and security of the housing sector. The crisis has increased the poverty, inequality, and hardship of millions of people, and has also increased the homelessness, hunger, and disease of multiple people. It has also led to an increase in crime, violence, and corruption, and has also increased the conflict, division, and polarization of many people. The economic downturn has heightened stress, anxiety, and depression for numerous individuals. Additionally, it has contributed to a rise in suicide, addiction, and abuse cases. The impact of the crash is also evident in increased levels of distrust, dissatisfaction, and resentment among people, leading to a surge in protests, resistance, and rebellion. Furthermore, the downturn has escalated vulnerability, isolation, and marginalization, worsening discrimination, oppression, and exploitation for many individuals. Potential solutions: government intervention. In the face of such a severe housing market crisis, calls for government intervention are likely to grow louder. Policymakers may explore measures such as temporary tax relief for homeowners, mortgage assistance programs, or incentives for home buyers to help stabilize the market and prevent a spiral of foreclosures and chaos. Additionally, federal agencies like the Federal Housing Administration, FHA, and the Department of Housing and Urban Development, HUD, could explore initiatives to provide financing options and support for struggling homeowners and prospective buyers. Investor incentives. To help absorb some of the excess inventory and stabilize prices, state and local governments may consider offering incentives to attract real estate investors back into the market. These could include tax breaks, streamlined permitting processes, or financing assistance for investors willing to acquire and hold properties for a predetermined period. The supply surplus could be gradually reduced by enticing investors to re-enter the market, allowing prices to find a new equilibrium and preventing further value erosion. Market adaptation and innovation. As with any major disruption, the housing market collapse in Florida will likely spur innovation and adaptation within the real estate industry. Agents and brokers may explore new marketing strategies and pricing models to better align with shifting market dynamics. At the same time, developers may shift towards more affordable housing options or explore alternative property types, such as multifamily units or mixed-use developments. Additionally, technologies like virtual tours and online auctions could gain traction, allowing buyers and sellers to navigate the market more efficiently in the face of oversupply. The Florida housing market is facing a significant downturn, and the signs point towards a challenging road ahead. Foreclosures, reminiscent of the 2008 crisis, could become a reality. The repercussions extend to homeowners, investors, and the rental market, shaping a challenging landscape for Florida's real estate future. It's a situation that demands careful consideration and proactive measures for those involved in the real estate market.